Good afternoon, everybody. Thanks very much for joining us for this really great online event looking at the GARBE pyramid research for 2026. And that's something that I always look out for as a real bellwether for what's happening in terms of the logistics market, and some really great insights from Tobias and Tom coming up. You can leave questions in the chat either on LinkedIn or on our site, wherever you're watching it, or YouTube. So please do put those in, and I'll be checking the chat, and so keen to pick up on your questions, of course, and any questions that you have for Tobias Kastner and Tom Herschaft. So really good session this morning. We're going to kick off first of all just with the main research from Tobias, I guess, in terms of the pyramid map, market developments during the second half of 2025, and also specifically looking at some of the forecasts for growth in rents and yields across Europe's leading markets. So really interesting to pick up from that. And then from Tom, we'll also have a presentation which is looking at specifically how you can manage to boost returns, manage to core strategies. So really looking a little more of a deep dive into that asset management side. So fascinating to pick up on those things. But without more of ado, Tobias, let's start with you. Just to pick up on the research side, and I suppose where you're seeing the market and what this, the pyramid research is telling us now.
Yeah, thank you very much. Just now I'm getting a phone call from my wife. So, let's start with a deep dive on our market developments. I hope you can see our presentation. Let's just skip to the main sites. I'm looking at the live screen. Yes, now I can see the slides as well. First of all, before we dive into the details of the markets, GARBE is a little bit more colorful, like you might have in mind right now. It's a little bit bigger, and we restructured quite a lot last year. And besides GARBE Industrial, that's a dash outlined the box, and we are Tom and I'm from the GARBE Industrial side, want to just give you the information that is a bigger picture, and we cover almost any asset classes, and we developed quite broad in the geographical sense. For example, last year we entered the Dubai market, of course, like Singapore the year before, to tap on the differences in when it comes to raising funds, tap on capital streams, etc. But more or less, we're covering within our GARBE Industrial scope almost all of Europe. And at the moment, within the all of the companies, we're around 600 people, but over 300 people working for GARBE Industrial. So this is reflecting our company, one of the biggest and company in the group, with over 10 billion assets under management and over 230 managed objects. So it's more important than ever to really have an active asset management team. Tom will cover it later on. And this is reflecting 7 million square meters rental space. When it comes to the pyramid map, Richard, it pleases me that we have the pleasure to have the 11th edition right now we're talking about. And with every edition we're releasing on a half-year basis, we have something new. Last time we entered the second tier round of forecast markets, now covering 88 markets, one of the broadest or widest coverages in the European research. And we won't go into the tier 3 markets because they tend to be so small. There's not so much happening that it makes sense to have a forecast there as well. So we focus on a different edition we are releasing this time. And it's a so-called loafing score, because quality is more important than ever. But I will tell you later on what's about the loafing score. Let's start with the background. When we start forecasting our markets 1.5 years ago, it was quite a different market situation back, and we wanted to show you the differences and what happened so far because the framework condition is changing all of the time. A few days ago, we had the economic meeting in Davos, and it was quite interesting to see what's going on in the world and the market. But the framework condition changed quite a lot in the past as well. So when we see at the end to 2030 where the rental levels would have been if the framework condition would have been the same, we see at the moment with the green line that we were a little bit more optimistic with the outcome. So the overall mood and the situation, dampened quite a little bit, and the same applies to the yield development. So the dynamic is a little bit slower at the moment when we look at our actual forecasts. What's behind it, and we just took some of the more recent headlines from different kinds of media outlets and companies. The mood is still pretty bleak. We know the situation in the market situation. It could be better. We are always waiting for the turnaround. But on the other hand, as you see on the left side, the economic outlook for the Eurozone improved despite the sentiment and the headlines. Well, it's not a huge step into the right or better situations to 10 or 20 bips, but still the news projection in GDP development gives us a better outlook, despite what was said at the Davos conference. On the other hand, you all might know the doomsday clock, which was invented after the Second World War, and we are more closer than ever to doomsday. So this is reflecting what kind of situation in the overall world we are living. And what was introduced as well last year, well, tariffs. Tariffs is bad for trade, but still, particularly the US are inventing raising new tariff barriers. On the other hand, you saw that the Eurozone entered the Mercosur trade agreement. Of course, we know it might take a while until it takes effect. But on the other hand, we entered a new trade agreement with India, and some others might follow, for example, Canada and other countries. So this could lead to a quite different kind of economic situation and trade system in the next years to come. And when it comes to trade and supply, we always had the discussion, and since the last few years, mainly since the pandemic, that we are talking about bottlenecks. And for quite some quarters, it was more like an excess supply. But this is turning around in a rather new indicator with an excess demand. So it could lead to, again, to some more bottlenecks in the world and supply chains, which lead to a higher demand in warehouse space. Where does the logistics property market stand? Well, reflecting those bad framework conditions, you could say, well, it leads to a worsening situation. Of course, the industry is aware of it and it's taking effect. But on the other hand, it's quite resilient, or more resilient than you might assume. For example, if you look at the take-up, it's more or less, especially for Q1 to Q3, like the situation before the pandemic. And before the pandemic, nobody was talking about a bad or worsening situation, but it was the market back then. So we're back to the market it was before the pandemic and the peaks. And if we don't have the final figures, but the first indications for the Q4 was that this was quite good. We made some assumptions for it, and we could end up with a slightly higher take-up and with more take-up, with increasing GDP to follow in the next years. On the other hand, many market participants discussed the increasing vacancy. Of course, We had a huge increase in pipeline and supply during the pandemic, and many of those project developments and schemes which were finished weren't able to be absorbed by the market. So there's was an increase in vacancy, but we are coming from an historical low, and this is Europe in general. It's rather different, or rather different, if you look into the different markets. We just took Germany here as an example, with a degree of 4% vacancy. But even in Germany, it highly depends on which markets you're referring to. We have markets like Leipzig with a substantially higher rate of vacancy, and markets like Hamburg, several other, which you can't even measure vacancy. So it's quite different. And again, it's more important than ever to really have a close look on locations, because it's quite different in different kinds of markets, countries, as well in the submarkets. When we are looking in the future, we are always taking the space under construction as a measure, and this is decreasing since a few quarters and years already, especially the speculative properties. So if the pipeline and the newly built space is decreasing, it could lead, of course, to a reduce that the vacancy is being reduced in the near future. It could even lead to what we call a peak cycle, when an increasing demand, when GDP is picking up pace again, and then the take up is met with an undersupply because the construction pipeline is slowing down. So it's rather resilient overall. When we are looking at the investment market, it's a different picture because it works with a different mechanism. Here, the volume was even a little bit decreased as when we compare 24 to 25. But again, we are more or less on the average of the pre-pandemic situation. But of course, everyone is waiting that the new investment cycle is about to start. And this is what we want to discuss with news data and time series today. Here we can see that the market correction in the pricing is already at an end. So anyone who is really still waiting for a market correction and cheaper asset might be waiting in vain, because here their indication with the poly line, the green dotted line, that the turning point is already lying behind us. For many of the small circles and dots there, we don't have any investment volume or the pricing. But when we model it, we still think that there are some outliers, of course, distressed asset on the on the one end, and rather highly priced, but not as high as in the peak of the market on the other hand. But we have a concentration point, and it's more or less stable since a few quarters. You can already see on the right diagram that we have a huge peak, which is not being reflected in the overall investment volume. Might because it was a company was bought and sold, and not individual assets. But on the other hand, for real estate research, it still it can be applied as an investment volume, and it's substantially high. So this could be the trigger point where the market cycle is about to start. It will be interesting to see what the next quarters will tell us. When it comes to the real facts and figures, of course, in the pyramid map, two of the most important KPIs are rents and yields. And here we can see that the rental growth phase we saw in the aftermath of the Ukraine war was coming to an end, and we have at the moment a stabilization phase. At the growth phase, we had an increase overall for all of the market, over 22% increase in rental volume, and this is slowed really down to only 3% in the last few quarters. But we can still see an increase. It's going on. We don't see many markets, only a handful of markets with which decrease. But the pace, of course, is substantially lower. And this is the overall market. But later on, we see there are still markets where we can see a higher rate of increase. On the other hand, the yield development, again, we saw the market turning point in the mid of 2022. And in a very short amount of time, in a few quarters, we increased or get a decompression of the yields with over 100 basis points. And this was substantially steeper than the compression phase before. So steeper and in a shorter amount of time, this was really a game changer when it comes to the investment market and the cycles. But since a few quarters, you can see it on the right-hand side in the stabilization phase, we don't see any major shifts anymore. We have a real stable development and with a really small compression with 5 basis points in, especially when it comes to the top regions. There's still going on for the overall majority of the markets at the moment. For the last half year, we see only as more or less a stability. Again, it's more important than ever to drill down into the markets, either countries or sub-markets. And you can see, of course, markets where you have, for example, a very huge development of the change in prime rents since in the last 5 years. And in comparison, even higher or lower development or positioning of the prime yields. This is, for example, interesting to see, for example, within the Netherlands, where you have a substantially lower average or the prime yield substantially lower than the average yield, or on the other, in the opposite, Ireland, where it is substantially higher, the prime yield above the average prime yield, despite having a similar increase of the annual change in prime rents. So it's quite different, and you really have to look into the mechanics, and therefore this pyramid map and the values presented within is quite helpful to identify those opportunities. When we drill down a little bit further to the top 5 regions, both for prime rents and prime yields, for example, within the last year, you still see some markets where you have a huge increase, and there we can point the focus on Munich, for example. We still see substantial rental increase, and Munich is now part of a set of maybe 5 to 10 markets overall in Europe, where there's really substantially higher rental levels than in the rest of the market, really with the demand level, because space is so scarce in the Munich region. And of course, if you see Berlin city, you have to differentiate between Berlin city and the surrounding areas. There's 2 submarkets we are covering now. Then it's even higher, because the space is so scarce within the city limits that the rental level is really increasing there as well. And for example, we have many markets, especially in the southern parts of Europe, for example, Barcelona and Madrid, where there is still rental development. This is because there's a huge demand or excess demand because the space per capita, for example, in logistics space is much lower than in the rest of the European Union, and there's still in quite good economic development, especially when it comes to logistic needs. On the other hand, you see, we already talked about the dynamic in Munich, but this is also reflected for the primary developments. We see a huge decrease there as well, with only a few other regions in the markets, 4 or 5. And on the other hand, the compression within the next top markets are quite close to each other, with only development for 10 bips or so. And this is quite painting a different picture. Many German market, but also many Dutch market, and of course Spanish markets where we see developments. So what's next? This was what we saw during the last half year. For the future, of course, we have the forecasts calculated, but would like to start with the swarm intelligence within the LinkedIn community. What do they expect? And here we see that there was quite an increase in the people saying that the rental levels will stay constant, or a drop in the assessment that the rental levels will increase. So this is more or less what we also are identifying as a pattern. You can see it here. We see on the broader market regions, for example, in Germany and Austria, it's a little bit higher than the overall of 88 regions, and especially UK and Ireland, mainly driven, of course, by the major hubs in and around London. And on the other hand, we have some southern markets in Southern Europe where we'll see a shift to an increased market dynamics as well. But overall, the dynamic is way below the increase or dynamic we saw between the start of the Ukraine war and the inauguration of Trump, as you can see here in the middle part of the diagram. For the yield developments, the difference between the change in the last Pyramid Editions survey and the current one is not so changing. You see only minor shifts, especially for the assessment that there's an ongoing decompression in yields is somewhat lower. So stability is seen within the market here as well. And we can see it here. It's not a total sidewards trajectory. We still see an ongoing compression, but at a really slow pace. For example, if you bought an asset during the peak of the market, you won't be able to see those net initial yields by the end of 2030. And again, as a value driver, the active management of real estate portfolios is more important than ever. So that's one of the reasons Tom will later on tell some insights what's important in the management of assets. If we look into the future, it's the same kind of diagram, but now looking from now until the end of 2030, we see the market development and the dynamic in Munich will keep on going, but we see also and Berlin as well, but we see an increase in rental levels for many other markets as well. Again, some German market, but also again some French markets, UK markets. So it's a mixed picture of many sub-regions where you see opportunities when it comes to the rental developments. And on the other hand, we see more Spanish markets when it comes to the yield development, the yield compression. We see some really interesting UK markets like Newcastle. We see a bigger change, or Valencia, for example. Quite interesting to see. And if you put everything together in a big matrix, of course, you will receive later on the total slide deck. There's a cloud of markets, and of course, we have to direct your focus on the lower right bottom, where we have an increase in yield and in positive rental developments. We will drill down into some markets where it's highlighted in bigger letters, but here you can really see markets where we'll have an yield compression and a rental development. Of course, the other markets are interesting as well, but the dynamic dynamic is slower, and not always you find a yield compression and a rental development. So give this one a closer look if you want to identify opportunities. So selective opportunities, that's what's going on. So we just took 3 countries, for example, France here, and 2 of the sub-regions, in this case, Lille and Toulouse, with different dynamics. And we see, for example, in Lille, the 5-year annual increase, and it will increase quite substantially in the future. Toulouse as well. Toulouse, for example, is a hub of the defense industry connected to Airbus, and this will outperform the rental growth level in the near future, or the future in general. And this is, of course, connected to the increase in the demand of the defense sector in general. So there are opportunities which are substantially different from other submarkets in France. Lille is a little bit different. It's a rather new market with lower barriers, entry barriers, with new supply, which could lead to a dampening of the growth outlook a little bit, but it still is one of the more interesting markets to keep in mind. As you know, Germany is as a polycentrical country, has substantially more submarkets, the 28 to be exact, 28, 29, yes, now with Berlin City as a own submarket. And here, like I said earlier, Munich is really standing out, and it will really increase in comparison to the 5-year average annual rent. So it's one of the highest of the total continent, but the growth is expected, a little bit reflecting the vibrant local economy. Much of the machinery and the everything is connected to, or in many instances connected to, the defense industry is located in the southern part of Germany, and therefore together with the much more hilly or movement of the topography, scarce product, and of course plots of land. So the possibility to grow there is quite limited, and therefore the rental levels are increasing. But there are many other markets as well, of course, more or less often the market where the consumer market or the producing market is located, but not always. So and therefore we have the Lofen introduced as well, because this is just an real estate economic view, but for the really the tenant structure and the stability of cash flow, other aspects are important as well. But before we come to the last part, to the Lofen, we keep a closer look to Spain, as we said, was one of the more interesting market at the moment right now when it comes to all of Europe. We have here Barcelona, which is really substantially growing, well, in the past as well as in the future, and Madrid as well, 2 biggest hubs. And this is because, for example, Barcelona is very limited for growth because of the natural geographical barriers like the land or the sea limiting the supply. And of course, Madrid, similar as Berlin, has a different pace when it comes to the cities or the inner ring and the outer ring. So again, knowing the dynamics of the different sub-regions is quite important for the future. This leads us to the last part. We're coming to the logistics affinity index. So in our opinion, we wanted to know how secure can cash flow be, because at the end, it's all about the cash flow from the tenant. And as long as the tenant is happy and the risk of vacancy is low, and the cash flow is more or less secure, and even we have possibilities to increase. So for all of Europe, we calculated a more tenant-based approach, which areas of all of Europe is more or less likely to be thought after by the tenants, or as a high degree of affinity to logistics itself. And you can see many green points or areas, and of course, on the opposite, many not so favorable areas in more reddish colors. For example, if you look to Germany, it's very interesting to see that Hamburg, from a tenant, from the logistics standpoint, is even better suited than the southern parts, or like Munich, even if the rental levels and yields levels are developing better there. But it's because it's has, of course, a bigger logistical performance based on the port, of course. There are nearly none topographical restrictions, and it's really good connections. So the connectivity is quite good. And of course, there's a big customer base, which in combination and some other different indicators as well is leading us to one of the best scores in the Lofin. On the other hand, on the southeastern side of Hamburg, when you look at southeastern, we have the areas where we have really bad connectivity because we are having gaps in the motorway system. We have a very scarce population density or low population density. So this is reflecting the low score. I could go on and on forever, but I think the point we're making is clear. We really have to look to the location, and it doesn't mean if you're a few kilometers behind the behind the logistics regions boundaries, that is a bad location, because as you can see here, there are many green areas where still highly favorable. But of course, the big quality of the logistics region itself is reflected in the high Lofin score. And for example, again, if you look to Spain, this is reflected for Barcelona and Madrid as well. But here you can see on the northern or northwestern part of Madrid that we have here areas which is dark green. So this is really good suited, but at the moment not really active from a real estate standpoint because there might be no supply or no construction schemes yet. Yeah, I think I will pass over to Tom, but last slides, conclusions, but it's what we said during all of our explanations. We will have a rental growth in many markets, but on a really restrained level, yeah, only a few cents in the instances in the last 6 months. But the outlook will increase, but with a really slow dynamic in comparison to the last cycle. On the other side, we will see an ongoing slight compression. It's really, in some instances, more a sidewards trajectory, but we don't expect any decompression anymore. But it's not enough to compensate the decompression. So that's why we said asset management is more active than ever. The value of portfolios is really increased. Yeah, through asset management measures. So with this, Tom, I'll pass over to you. I'm muting myself, but I'm, yeah, well, clicking through our slide deck.
Great, thanks very much, Tobias. Super. And over to you, Tom.
Thank you so much, Richard and Tobias, and welcome from my end to everyone here in this call. I'm very excited to be in this year's Pyramid webinar. As far as I'm concerned, I think this is the first time real estate management, is presented, and I'm very excited to do so. So I'm Tom Herrschaft, and I'm heading the real estate management division at GARBE Industrial. Yeah, seeing your slides, Tobias, is always fascinating to see what conclusions you come up with your research team. And that is based obviously on a systematic approach, and that's exactly what we do in the real estate management division as well. But first of all, where do we sit inside the GARBE Industrial organization? You can see on this slide, and some of the listeners and viewers may know this, but we have a 360 approach, and basically 4 service offerings to our investors and partners. On the upper end, you see wherever, with the investment management and project development, you see this is about, new projects or new properties coming in. And on the lower end and lower side, you see portfolio management, real estate management. Well, that's, managing existing portfolios, existing properties. So on the left side, this is basically the capital side. That's, an investor contact to investors. On the right side, project development and real estate management, well, we only focus on individual properties, and that's all our focus is on. So, but how is the organization, or basically our division structure, the real estate management division, that is shown on the next slide. So we basically look at 4 individual teams. Then you may all know asset management, is widespread, word also used in the financial industry, but we in the real estate management, real estate industry, we like to use it as a job for being entirely responsible for the commercial performance of a property. So we call it the CEO of the property, or also the main contact to whoever is the investor representative. All the leasing negotiations, the strategy set up for a property is basically responsibility of asset management. Property management, on the other hand, is day-to-day operations, the main contact for all service providers, main contact for property accounting, and that is all supported by technical management here, the third column, which is obviously repairs and maintenance, larger projects, and cost accounting. So in our organization, which is a vertically integrated organization, meaning that we have both asset management and property management, which is not so common actually, and I think is a right approach because it avoids unnecessarily interfaces and reduces miscommunication, and basically both are supported. All 3 pillars that I mentioned before are supported by central services and systems. What do I mean by that? It's basically ancillary cost reconciliations, for service charges. It means all the ESG measures that we undertake are centralized. It means that all the data management is being done out of Hamburg, where the headquarters are located, and these central services. So all the IT, all framework agreements that guarantee a certain threshold of quality and consistency across all the regions. So one of the key aspects of GARBE's approach is a decentralized one. So we try to give individual regions a lot of responsibility, and that is shown on the next slide. It means and you could see for what Tobias presented is that Germany is not a centralized country, obviously. So we have a polycentric country with different hubs, and also in different industries being focused on different areas in Germany. So for example, Hamburg has a completely different industry than compared to Stuttgart, and the same applies for the requirements for industrial properties. So we call our approach boots on the ground. Basically, be close to your properties, be close to tenants in the markets. We have 6 regional offices that you can see here on the map on the right, so there's also regional leaders who have lots of autonomy and an entrepreneurial approach. They within those offices, the teams work what we call like, you know, property teams. So there's always, for each individual property, there's a one responsible asset manager, one property manager, and a technical manager, and they, you know, form a responsible team and try to tackle all the individual challenges, you know, in day-to-day operations as well as strategically in this individual team headed by the asset manager. So so we think at GARBE, you know, like a high consistency of the quality of the personnel is key to performance. So and that is our approach, that, you know, like basically we try to guarantee, and it's particularly my focus, to guarantee that you know, consistent performance across, you know, all different disciplines, across all levels. And we work with lots of like with all types. I mean, we have close to 200 assets across Germany. So that means, you know, we deal with all different types of industrial assets, not only logistic assets, but also production facilities, you know, cold storages, last mile infrastructure, you know. So we see, you know, we have obviously connections to various kinds of tenants, and see larger trends. We lease each and individual year, we lease a lot of square feet of space to our tenants. Last year it was like, you know, more than 700,000 square meters, 700,000 square meters, you know, which is more than 7 million square feet just in this portfolio. Big part of really coming from new leases, not options being exercised. And we work with various investors, so lots of individual mandates, Anglo-Saxon investors, you know, very prudent and conservative German core investors, and also we work with like GARBE Capital, as well as you know, entirely for third-party mandates with no affiliation whatsoever to GARBE Capital. So with that being said, this describes how the real estate management team works. However, you know, we have a lot of connections to either internal or external parties, which the next slide is showing. It basically it's always very important to me, because I think, you know, I want to show how the complexity of real estate management, because it means you have to have a, you know, like a thorough understanding about all these cross sections with other disciplines. So you know, be it you know, development, be it, you know, the investment side, and basically the volume of those boxes shows the intensity of the cooperation. The blue boxes show what we can the services or shared services that we offer internally. Gray boxes here is externally. This is not well, you know, there's even more to that, you know, but due to the you know, size of basically the slide, we kept it like that. So on the one hand, you know, each individual expert at GARBE needs to be, you know, exactly that, an expert in their field. On the other hand, you know, they need to have a continuously developing understanding of what's happening, for example, in the financing field. So, you know, that is everything to GARBE in itself. Basically, in a few weeks, you know, if you think back and wonder, you know, what we stand for in a nutshell, you have basically the elevator pitch on the next slide, which I will not go into too much of detail, because I would highlight our understanding what active management means. We have a small, you know, case study, but what I would really like to do is show the contribution to an active management approach from each of these four pillars that you saw in the beginning on this one slide, that, you know, the real estate management team consists of. So here we, you know, due to confidentiality, obviously, you know, we don't want to disclose the site specifics here, or the tenant name, but it's a building that was like a storage facility built in the early 80s in Berlin. So medium to large size of approximately 18,000 square meters. Has 2 tenants, and at the time, you know, it has a very short lease term left, especially with the main tenant. This main tenant had good, you know, great credit, but at that time, you know, there was a big discussion about some maintenance costs that basically, you know, both sides, the landlord and the tenant, couldn't decide on who was responsible under the lease to pay. And then obviously with 12 months left on the lease, you know, it's not a great starting point for a renewal. So that was one thing. And on the other hand, the building quality in itself was not great. So it was a storage that had no heating. So basically only, you know, suited for storage, no air conditioning, had you know, obsolete technical equipment, and there was no ground level storage area. So basically, if you're looking at a reletting scenario, you were everybody, and especially the investor in real estate management, it was clear that there was lots of retrofitting needed and lots of modernization capex to be put into basically you know, take advantage what was in place and an under rent. So it was heavily under rented, but at the same time, in order to tap on that under rent, basically you would have to invest lots of capex. So that was an issue. And the market environment was like, the competition was also not easy. So you know, lots of modernized space in the area, and the visibility of the space was not great, and so forth. So what do we usually do, or what the team did back then was, first of all, you have to align and understand what the investors' requirements are, right? So do they want to dispose of the property quickly? Do they have, you know, capital that can be spent to modernize? So what are your options? And this is exactly what they did. And it was clear that basically was a two-step approach. First of all, they tried to improve the tenant relationship. There was a legal fight again about these maintenance costs, and use these costs or these repayment from the tenant, which was in doubt, basically as an incentive and part of a negotiation about a new lease. And also be bold in that claim to get to the market level of rent. And the approach and the result is shown on the next slide. It's exactly what the team did, but it was also supported by a technical upgrade of the space. Not a complete modernization of the entire facility with heating and everything, but basically, you know, sprinklers, electric, and the smoke exhaust, which I show later on the slide. But here in this case, the tenant relationship improved a lot. You know, it was clear that they were looking also at other space. At the same time, you know, we or the team were being reflected that all the brokers didn't see a lot of demand again for our property, which was not, you know, surprising to us, again because of the state of the facility, and that approach worked very well. So the lease was extended by almost 10 years, and the team was also able to pull up the rent by 67%, which is a lot. Again, it was under rented, but basically they were able with this property to catch up with market level of rent, and there was also a significant impact to the property value. But all of that would not have been possible with the support of the technical management team. And to show you what they did as part of the technical upgrade, shown on the next slide, you can see here, and again, who's familiar with the logistics space, usually have these skylights, which have a mechanical opening, and subject to a detection of smoke or heat in the building, these get automatically opened, and there was an issue with that because it was completely oversized on one hand, which increased the maintenance cost by a lot. So from all of these skylights, they amounted to 244 on the entire roof of 140,000 square feet. So yeah, it created a lot of costs, and at the same time, you know, as you can see on the lower left of the slide, the solution, or the way the mechanical opening works, was with this pyrotechnic solution. So NRA means this natural smoke and heat extraction system, basically the skylight, which was automatically opened, and it had these small cartridges, right, that basically blew up the window. So or opened the window, but sometimes, you know, it got damaged on the way. You know, they had to replace all the time, which was very costly, also to the landlord every 3 years. So the team solved it, that they actually replaced it with this pneumatic NRAs, which can also, again, you know, from an ESG standpoint, you know, it's much more sustainable. It increased inspection costs. It decreased inspection costs and decreased the costs to the owner to replace all these cartridges. And it opened up also possibilities when it comes to cooling down the space overnight and during summer. So it was really a win-win. So basically, the cost for the tenant were lowered, the cost for the ownership were lowered. It was very helpful to have it as part of the negotiation, and I think is a really nice example of cooperation between asset management and technical management. So I covered basically those two disciplines, but I want to basically also point to what I think is an underappreciated aspect when it comes to real estate management, because everybody looks to returns, everybody looks to revenue and rental income, but you know, good and qualified property management, I think, is invaluable, because it looks at costs, and to some investors these are just line items. To us, you know, these are costs that are being vetted, you know, be it the height, you know, basically the volume of the cost, the origin of the cost, and as well as, for example, if you order repair or, you know, gardening service or whatever, you know, the team also looks not only if the amount is within, for example, last year's expense or the previous year's expense. They benchmark it against like a system that we have internally, because we manage so many properties, so we know more or less what you can charge for certain services, and they also look actually if the service provider did exactly what's written on the invoice. So I think that is invaluable. Again, also we have we negotiate large framework agreements that lower costs, and we have this qualified personnel that exactly trained for logistic properties. So the fourth pillar that I mentioned previously is central services, and you know, and nowadays obviously it's also a presentation is not complete if you don't touch on ESG. So one of the services that our central services are providing to the regions are ESG consulting, really focused on the properties. And here's an example of what that can look like. There's two axes. One is cost and time. It shows, you know, basically the cost and time impact of certain measures, ESG measures, and you can see here in different colors those individual measures. So if you put a PV plant, photovoltaic plant on top of your roof, well, you know, it will take some time and it's obviously quite costly. On the other hand, you know, there's preventive measures, ecological measures that are much more cheap and much more cheap and quicker to get. And what that can look like is shown as a practical example on my last slide. For a case in North Rhine-Westphalia, it's a quite large property where you know, most of these measures that are shown here in the model are also being realized. One is, for example, you build a large green belt around the property. You make a preparation for all the technical systems for later, photovoltaic installations. The middle part here is a new build, and the concrete for this new build was recycled concrete from the demolished building from before. And again, the old building on the right side, the existing building was retrofitted with LED lighting. I mean, it shows the extent and the amount of measures you can actually undertake. All right, but with a view to the clock, I would end my presentation here. Thank you for your attention, and I would give it back to you, Richard, for questions.
Great, thanks very much. Really interesting to get those examples, I think, as well, Tom, just in terms of being able to drill down into that. Just a reminder to everybody that if you look on the right-hand side of your screen, you'll be able to see the chat. So please do put any questions into that, and I'll make sure that we answer those. A quick one from me, Tobias, just to start with. You mentioned there, of course, the market is back pre-COVID. I suppose, what do you think are the main reasons for the resilience, if you like, of particularly the logistics side within Europe?
Well, one of the most important feats of logistics asset is the very broad tenant base. It's often you have the situation as one tenant base is struggling with anything for let's say e-commerce. During the pandemic, it was really thought after, and every square meter which was available was being let to anyone who's sent out anything through e-commerce channels. There was in substantially increase in pipeline and additional stock. Afterwards, it really dropped down, and we had really have a problem. But it's just there's an oversupply on one hand and the undersupply on the other hand. Later on, it was really, in a few quarters, getting back on its feet. So with additional tenants coming, for example, from the Asian markets to Europe, not the other way around anymore, but really renting space here. So this is what I'm trying to tell you, is that is changing all the time, but together with the other industry, pharmaceutical industries, even automotive, it's facing challenges, of course, but we even were letting to automotive industry last years. Or in the last year. So, and of course, we have the defense industry as a new driver coming on top on the traditional drivers. But in general, for all of the years, especially together with the 3PLs, we have a very broad tenant base. And despite facing some struggling with some issues, we're always having possibilities to focus more or less to other tenants if some of the industries is facing problems.
Yeah, I mean, that it's interesting to pick up as well, I think, on some of the areas like rents. You mentioned obviously vacancy as well, and that you were expecting there to be kind of muted rental growth, but not necessarily high rental growth. But what about some of those areas, Tobias, where you're seeing very, very limited vacancy? And of course, there hasn't been a huge amount of speculative development over the past couple of years. So do you think we'll really have almost a two-speed market in some of these hotter locations where you are going to see significantly higher rental increases in those markets?
This could lead to this conclusion, yes. We saw in the last years the scarcity of land plots. Of course, at the moment, we have some insolvencies and bankruptcies in companies, so we're having increasing amount of brownfields coming to the markets, and in many instances, greenfields which were being held by investors, land banked, were coming back to the market. But it's just a momentarily or brief situation, because in general, we have the situation that by the end of 2040, 2050, there's a net zero policy still in place, which leads to the fact that the scarcity of land plots is becoming a bigger problem. So focusing on stock and being able, again, I'm here with Tom, to work on the asset is for the future really important, because the newly built supply will decrease over time. So yes, the speed will change somewhat, and we saw different patterns in where the location of new supply is located. Again, in the last years, we saw a situation that the pipeline it went into the peripheral regions because there was workforce available. Problem, there was electricity available and even plots of lands. Now it's coming back to the centers where the people, the consumers, and the production sites are located. So, and of course, for the e-commerce industry to being able to move goods even faster. So that's we're moving back to the city centers again. So this is changing all the time. But the scarcity of land in the top markets with the situation we're seeing right now, this will keep on going, and there we'll have the most, the highest lack of possible available space of land and even space in warehouses.
Great. And Tom, just to you, very interesting to see those initiatives, and especially the sort of innovation in terms of the technical elements as well, and the savings that those can make, as well as obviously the increase in terms of value. Just be interested to get a sense of, in general, when you're talking to the tenants, is everybody open to these changes? Do you have to deal with different tenants in different ways? Because obviously those are, it's quite interesting to see whether that is different between different regions as well.
Yes, absolutely. So also what Tobias said is, I think this is one of the opportunities within the industrial market, that you have these I always like to say, lease kind of being a derivative or compared, to a bond in contrast to an equity when it comes to the company itself. So, or the economic strength of a company. So some of the companies do quite well. Some companies struggle, which maybe were over expensive over the past years. For example, in the e-commerce boom, you can see also some stronger names, some names that struggle and sublease. So it's a very mixed pictures. But I would say that the mixed picture and the problem of some tenants, can lead to opportunities for a landlord to recapture space and relet it. And we have examples where exactly that happens. That basically you use those different cycles, economic cycles, and demand and supply cycles from your tenants, from the underlying business, and you use that to basically recapture space, relet it, obviously in cooperation with the tenant, to maximize your property value. So yeah, but we see everything. We see extending leases, new leases being signed. We see some tenants struggling, but again, it's a very dynamic space. We from the headlines, you could deduct some massive impacts, for example, in the automotive space in some regions, which we don't see, for example. But it's a very mixed picture.
And I guess as well, you mentioned there ESG as and sustainability as one of the kind of key elements, and of course power and access to power has been a very big driver from the occupier side. So it'd be interesting just to pick up on that. Are you seeing more in terms of the asset management side of using more sustainable power sources, also as a way of reducing costs and increasing efficiencies, and is that also welcomed by the tenants?
Yes, I mean, I would say the larger tenants are, Some smaller tenants, they struggle, I think, with the with the cost savings that come with it. So and it's also, we call it sustainonomics, at GARBE, our approach, that trying to combine profitability with an ESG approach, to really look at what adds value. And at the same time, you can also look basically contrast well with the feedback that we get from tenants. So one of our affiliates, they plan and build photovoltaic plants on top of our facilities, and they provide tenants with PPAs, right? You can buy directly power from those plants, but some tenants are really reluctant with that. But I think it's really caused by the complexity of doing so and the cost savings that come with it. So and I hope this will improve. Again, maybe it's to decrease bureaucratic hurdles, but it's a very individual approach. And I would say usually the larger tenants, they are able to afford, by a systematic approach also, those topics much better than the smaller medium-sized enterprises.
Yeah, interesting to hear that. We're right up against time, but I've got one last question for you, Tobias, if I can, which is, if we look at the research and we look at how that's moving in terms of where you're seeing the opportunities, where we're looking at the heat map, and we will share those slides with everybody so that you can see that. But for those in this session who weren't able to absorb that and look at the detail of it, are there particular geographies? You mentioned Munich, of course, locations where you're seeing greater opportunities, I suppose.
Yes. What I try to point out is that we really see many markets in the southern parts of Europe, especially Spain, but also Italy. Well, the economic development in Italy might not be as dynamic, so we don't see in the forecasts so much movement. But I think this is more because of its the regional economic forecasting methods. When we really see on the logistics driver, it might come to the situation that it will be in more dynamic development of rental, because we just see the tenants coming to the market. It's really an interesting space, and like Spain, we have there a per capita lack of space in comparison to other markets, so they really have to catch up. This is in contrast, for example, to the central and eastern parts of Europe, where we saw this already, this really big increase in pipeline and stock. So because there's a situation we're facing right now that we have much stock, unlet stock available, because the absorption rate dropped so significantly. But this is not the case for the southern parts of Europe. Then, of course, we have all those focus points, for example, where the defense industry is located. There couldn't be an impact for surplus demand. We see it already in some markets, France, for example, or UK, which is really rebounding already. It's one of the front runner always, and it looks like we're seeing this again in this new beginning cycle. In the longer term, when we reflect those differences in geopolitical trade changes, trade agreements, how the supply routes changes, then this could lead to a situation, for example, where the access to the southeastern parts of Europe, for example, in the direction of Turkey, the Adriatic Sea, could lead to an increase in demand. It's one of the reasons, for example, why we entered Romania, because we see opportunities there. But this might take some time to surface, to develop. This is more a longer term development. But the overall picture gets broader. It's more more hotspots are evolving and they are changing. So this is really important to have a big picture and to really have also 100 over 120 regions in Europe under surveillance and see which is where the patterns are changing.
Yeah, it's a really interesting picture at the moment, I think, when we're looking at logistics, especially the influence of some of those geopolitical elements that you discussed, and what that means in terms of nearshoring, friendshoring, but also that element of defence, of course, as an active driver for logistics over the coming period as well. Thank you, Tom. Thank you, Tobias, for sharing your insights and the latest research from GARBE. Thank you to everybody from joining us. If you're joining us on demand, thank you very much for watching. And if you want to learn more about GARBE and sign up for the newsletter and get updates regularly from GARBE and the research team, at the end of the webinar there will also be a QR code that you can just use, and that will be able to connect you to all of the updates. Thanks very much. Thank you again, Tom and Tobias, and thanks everybody for watching. Thank you.
Thank you. Bye.